Welcome to Investment Literacy, the investing habits. Today I'm going to share about risks and returns in investments. And most people would prefer to talk about the investment returns first. This is because it's much easier to get people to be interested on and excited about the returns and subsequently to take action on it. However, this investments emotion-driven decision sometimes is difficult to reverse. So in real investments, the risk will come first. Only then we talk about the returns. And this is because if risk is unacceptable, then no matter how high the returns or attractive the returns, it becomes meaningless. So today's the topics have put the sequence correctly. Risk first, and we talk about the return later. So let's talk about the risk of investments first. And the first thing we need to do is to, to define what is the risk of investments. And this is important because it helps to set an investment directions. So there are various kinds of definitions about risk. And one of the common and famous risks of investments is the price volatility, which is the up and downs of the price movements. The higher it is, the more volatility, and then the higher risk. So imagine if you put 10,000 ringgits under a pillow and you keep it for 5 years. 5 years later, you took out that amount, same amount under the pillow, 10,000, and the price volatility equals to 0. That means you have no risk of putting the 10,000 ringgit under the pillow. And if you compare with another options to deposit the 10,000 into the bank, and 5 years later, you could withdraw more than 10,000. That is considered higher risk. This is because the amount have changed from 10,000 to now more than 10,000. So I do have different kinds of definitions, and I categorize this into two. First is the individual risk, and the second is the asset class risk. And when I talk about the individual risk, it's basically referring to the risk of not knowing what you are doing. And this is very tricky because most people will think that they know everything, or at least they know something. And this will give some confidence for them to make the investments decisions. And sometimes it's overconfidence. And one of the example is the collapse of the Silicon Valley Bank in the United States of America recently. And of course, some party will put the blame on the Federal Reserve because of raising interest rates and causing the banks to collapse. However, it is the top management of the Silicon Valley Bank that operate the bank and makes the investment decisions, not the Federal Reserve Chairman, because Federal Reserve Chairman is oversees the economy of the United States, not the Silicon Valley Bank. So next is the asset class risk. So here we want to know in any particular investments, is there a cap on the losses of investments? Right? Every investments have a potential of loss, but what makes the difference between these assets class is whether any specific assets loss, possible loss is capped or not. So if it's not capped, meaning one investment will have unlimited losses, and that will jeopardize the personal assets, which means if you invest in a specific investments with unlimited loss, you have possibilities of losing entire saving and all other assets that you have. So in Malaysia, to put in perspective, we have three commonly invested asset class. First is the share markets, and then the unit trust, and we have property markets. And if you compare these three, and then based on the Director of Insolvency's uh, records that shows the bankruptcies in Malaysia, you will not find people bankrupt because they invest in share markets or they invest into the unit trust. However, property investment emerged as one of the top bankruptcy in the Malaysia market. So this means property investments carry the higher risk amongst the asset class. So this is because the natures of the asset class itself. People borrow money to invest in properties. And for instance, if you borrow 600,000 back in 2020 when the overnight policy rate at or the interest rates, overnight policy rates, yeah, at 1.75%, today is 3%. And if Bank Negara increase another 50 basis point and make it 3.5%, that means your loan amount from 2020 600,000 today will become 1.2 million. And these interest rates have no limitations. There is no cap on how far or how high the rate will go. So investors are open up to unlimited risks. On top of this, property investments does have transaction fees and also ongoing fees and charges as well, which are different compared to the other two. Now, if you look at the share investments, there is a transactional fees, but relatively it's very small percentage compared to the property, and there is no ongoing expenses uh, as in the share markets. And if you look into the unit trust compared to the property, both unit trust and property will have transactional fees plus ongoing expenses and charges. However, unit trust work within the assets itself. That means unit trust investor will never pay anything above the capital investors. So worst case, they may lose out the capital investors, but nothing more than that. However, property investors is different because they are required to pay on top of the capital investors. That means they will lose more than the capital investors invested. So that will mean the property investments have higher risk. However, if you look at the price movement, property asset property investments, it doesn't move price every hours or every day as compared to the unit trust and the share markets. However, you can see over here, it is not the price that dictates the risk. It is the nature of the asset class that dictates the risk of investments. And that is the risk of investment.